Live. Ladies and gentlemen, hello and welcome to an exclusive Liberty Real Estate Fund webinar. What are the top 7 net lease secrets? I'm your host, Adam Carswell, joined by my good friend, boss, mentor, and single-tenant triple net lease master, Michael Flight. Michael, we have quite a show in store today. Any ice-breaking comments from you for our audience?
Well, I'm just happy that everybody decided to show up. Really looking forward to this, and looking forward to talking smack about multifamily a little bit and talking about how great net leases are and why, more people should be investing in net lease.
Absolutely. And so, hey, guys, if you're with us here live today, again, thank you. Hello. We really appreciate you investing your time with us. Let's go ahead and get the chat box warmed up. Punch in who you are, where you're at, where you're tuned in from. And again, we're super excited because we know we're going to be giving a lot of value today. So we've been working diligently behind the scenes on this presentation together. Real quick, I also want to give a thank you to our team, Courtney Stone, Sharab Islam, Jordan Steck, Sam Halawi, Jason Ricks, all put a ton of work in to help this come together today. You guys played a major role, and just this presentation couldn't have come together if it wasn't for you guys. So thank you for all of your hard work. If you're joining us on the replay, be sure to like, share, and subscribe on the platform you're tuned in on. Check the show notes for links tied to today's message. And if you're listening on the Dream Chasers platform, be sure to drop us a rating there and follow a link to the video replay. All right, so it's time for the presentation. What are the top 7 net lease secrets? We've got, as I mentioned, the master of single-tenant triple net lease real estate, Michael Flight, with us here today. Quick bio on Michael, and I mean, this is going to be a complete understatement. I'm sure we could do like a 30-minute bio if we wanted to, but Michael's been in retail since 1986. That was 5 years before I was born. He knows net lease real estate. He's done hundreds of millions of dollars worth of deals and transactions. And I just can't stress enough, again, how much of an impact he's made on my life, and then also in the sector. He really knows his stuff. So Michael, any other fill in the blank moments for your intro before we get to the presentation?
No, thank you very much, Adam. I really appreciate the introduction. Just a little bit, we've been in business since 1990. We specialize in shopping centers, retail real estate. Just have a slight bit of experience doing this stuff. So wanted to, I've always been really excited about it. And quite frankly, it's the only thing I know. So, I have done other types of properties. We've done apartment buildings. We've done single family rentals. We've done office buildings. We've done a number of different things. And I also wanted to introduce my co-host, Adam Carswell. I like to call him the voice of Liberty because he's also the voice of Liberland for the Liberland show. And Liberland is a startup country in the middle of Europe, but we won't get too far into that. But the really cool thing about Adam is we met a few years ago. He reached out, he pursued me, he actually stalked me, and I eventually gave him a job. But the amount of the different types of people that he has interviewed is just incredible. I mean, he is really a go-getter, and he's very modest, but he also knows the net lease space. So thank you very much, Adam. Let's take it away with secret number 1.
Let's do it. And ladies and gentlemen, we will be doing about a 15-minute Q&A after the presentation today. So please, as we make our way through this, just get some questions ready for Michael. I'm sure you're going to get a ton out of these secrets. So as you mentioned, Michael, without further ado, let me go ahead and share the screen and get this show on the road. There's the present button. Present. There we go. All right. Oh. Michael, take it away.
All right. Well, Adam, why don't we go to secret number 1, which is really not a secret to people on the call, because they know that real estate is the original asset class. It's the world's most proven asset class. And no other investment. Well, actually, so, and it's also, Adam, can you move up one more
Sorry
slide?
about that. We're
Yeah, they're right there. So it's the original asset class. So before stocks, before bonds, before everything else, real estate was there. People have been fighting over real estate. People have been buying real estate. People have been improving real estate. So we like it because it's tangible asset. It's a great inflation hedge and a number of other things. So Adam, why don't we move to the next slide? Um, and as Gary Keller says, and Gary Keller not only started Keller Williams, but he also wrote The One Thing in the Millionaire Real Estate Investor. No other investment has had such a consistent positive effect on the average person's net worth. So, and we truly believe that. I'm a huge fan of Gary Keller, and I'm a huge fan of all the people that have come into the real estate space probably since about the year 2000. I can tell you that when I started out, there was a real estate industry. It was a large divide between commercial and residential, and there wasn't a whole lot of anything in between. So why don't we give them a comparison to show them about how the asset classes stack up? So global real estate is $280 trillion. Now, the cryptocurrencies have jumped up a little bit in the past year. So with Bitcoin, so it is a little bit bigger than that, but it's still extremely small. And as you can see, the stock markets are, extremely small compared to real estate. And then global debt is your bond markets, and the global debt. Most of that is government debt. So a very few of it is industrial and corporate debt. And you can see global real estate even outpaces GDP, oil, and especially gold. So the two tangible, or actually the three tangible assets in there, except oil is a consumable, are gold and real estate. And we believe that everybody should own a lot more real estate in their portfolio. I just want to talk smack about the bond markets. There's absolutely no interest on bonds right now, and there's just it's just not a good situation. If you're like investing in bonds and hopefully, saying, oh, that's a flight to safety, I there's a huge chance of default, especially on sovereign debt. And also if you're investing in state, municipal bonds and that type of thing, because most of these municipalities and states and everybody else have underfunded pension liabilities. So there's some good states out there, but the risk premium for that versus going for real estate, it's just crazy in my mind. And then the other thing is the stock market. Right now, the stock market is pumped up with all kinds of funny money because the the Fed just printed trillions and trillions of dollars. And so we know that at some point that probably is going to come crashing down. But if you want to take your winnings off the table now, I would put it into any type of cash flowing, improved real estate. And then cryptocurrencies have been the darling of the investment world in 2020, and Bitcoin, I think, is still up around 30 something $1,000 today. But the volatility in crypto, you're not going to get that in real estate. And then it's really hard. I mean, people are going to argue with me and say, oh, there's DeFi and blah, 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 blah. But it's really hard to get cash flow out of crypto. Especially if your underlying asset is so volatile. At some point, if it drops below what it is, you're going to lose your asset. So we really, really, really think that real estate is the way to generate wealth and create human flourishing worldwide. And it's also the world's largest asset class. Thank you very much, Adam. Let's go to the next one. All right. So we just want to reiterate the benefits of investing in real estate. As we know, it's consistent income. You've got regular cash flow. If you're investing in cash flowing assets, you have to make sure that it is a cash flowing asset, not a development deal. We know that family offices, institutional investors, insurance companies, pension funds, all and high net worth individuals all invest in real estate to not only generate wealth, but also to preserve wealth. Real estate, as we talked about, is a hard asset. It's just it's something that you can put your hands on. It's something that's tangible, and it's something of value. So if you invested in one of those municipal bonds, at the end of the bond, it's gone. You have nothing left. And then we can put leverage on real estate, and you can actually put a lot more leverage. You can borrow money, put a mortgage on real estate more than you can with most other investments, because it is tangible, and banks love to lend on something that they have collateral on. As we talked about before, and we are looking into the abyss of some real inflation with the amount of money that's being printed. You can see the inflation already working its way through the economy. So real estate is a hedge against inflation, and the type of properties that we're going to be talking about today are an especially great hedge against inflation. Real estate also has some unique tax advantages, and it's tax efficient. But in most countries in the world, including the United States, real estate is something that they want people to improve. They want investment in real estate. They want this type of thing. So the tax laws are written to create investment in real estate. And so that's why it is tax advantage. And then we can go back to real estate is a historically stable asset. It's usually slow to rise, but it's also slow to fall. So you're not going to like lose all your money in one single day like you would in the stock market or in cryptocurrency. But if you do get what we call an alligator, which starts eating into your cash flow, it's death by a thousand cuts. So hopefully you'll be doing a lot of homework, and you'll be investing in something that has consistent cash flow. So even if the value of the property rises and falls, if you've got the consistent cash flow there, you're really investing in the cash flow, and then the asset appreciation is an extra bonus, plus the tax advantages. And I love this quote from Andrew Carnegie: 90% of all millionaires become so through owning real estate. And then if you, they're still publishing the Forbes 400 list and the Forbes World Billionaire list. And if you take a look at, even if they made most of their money in one particular area through industrial or through stores or something like that, they always invest their money in real estate to preserve that wealth and to diversify their wealth out of their main business. Okay, so secret number 2 is advantageous lease structure. So we are talking about triple net leases. We're also talking about net lease properties. So triple net, net, or NNN, or net lease are all the same thing. It refers to a where a tenant pays for the taxes, the insurance, and the maintenance. Now, the first net is taxes. So that's a single net. So if you've got a lease where the tenant pays you the real estate taxes, that's a single net lease. If you've got a lease where the tenant pays you also insurance and pays for their own direct, or pays you, reimburses you for insurance, that's a double net lease. And the next one is a triple net lease, where the tenant pays for everything. The tenant pays for the taxes, the insurance, and they also pay for the maintenance of the property. So that includes like sweeping the parking lot. Where I live in Chicago, you've got snow plowing. So the tenant does that. They shovel the sidewalks. There's none of that for you. The tenant takes care of their landscaping. The tenant also maintains their HVAC, which is heating, ventilation, and air conditioning. And in a true triple net lease, the tenant pays for their and maintains the roof and the structure of the building. So the walls, the columns, the anything that holds up the roof, and the slab and the concrete below it. You need to make sure, and this is a hot tip, because a lot of brokers will advertise triple net leases, and then when you actually take a look at the lease, for example, there's a lot of Family Dollars out there. And they're good looking properties. They're brand new properties, and they're very attractive cap rates. But if you look at the lease, it is a double net lease. So the tenant pays for maintenance of the property. They pay for maintenance of the interior. They pay for landscaping, cleaning the parking lot and things like that. But the landlord is responsible for the roof and the structure. So if it is an older building, that could come back to bite you. I'm just going to tell you, in my 30 something plus years of experience, every flat roof leaks. And the type of tenants that we're talking about almost all have flat roofs. So even if it's a brand new roof, there's always small little leaks in it. That's why they have maintenance programs and things like that. So always be careful to read the lease. But the best thing in the world is the tenant on a triple net lease pays everything. So why don't we go to the next one, Adam? Okay, so my friend who I've had dinner with and met through the real estate guys, Robert Kiyosaki, I mentioned to everybody that I've never read his book, Rich Dad Poor Dad, but I admire the guy because of the amount of people and the amount of financial education that he has created. He single-handedly, most of the people that I meet that have gotten into the real estate industry or interested in real estate since 2000 has read that little purple book. So we really have, and I've gotten some value out of his podcast in the past. So, but he's a good guy. All right, next secret, number 3, mailbox money. This is where we get to compare multifamily versus net lease properties. So we talked about that advantageous lease structure. So this is what it actually looks like and how it comes out. So we've got 2 different properties side by side. I actually own this multifamily apartment building. It's in the Chicago suburbs. And I can tell you that even though we made money on it, it was an unbelievable hassle because we constantly had we had some issues with tenants. And so one of the issues was there was a tenant dealing drugs out of there. And so we had the police show up and we had, complaints about that particular tenant. And this was in a nice neighborhood. This was not like a slum by any means. This was like a really attractive building, really attractive neighborhood. And if you look at the CVS sitting next to it, there's drug dealing going on with the CVS, but it's all legal. So you don't have any problems with people dealing drugs out of there. But let's take a look. You can see all the expenses that go into, and these real estate taxes are probably low. This property was in Cook County, and the real estate taxes there are just incredibly high because they punish commercial real estate. But, you can go down. So the only thing on the net lease CVS side, oh, and by the way, it's like, this property is available. It's down in Florida, right next to the, and this is about what the actual net operating income is for it. Right next to the beach, everything else, why wouldn't you do that versus shoveling snow and dealing with, hassle of tenants over on the other side? So you can see the gross income side by side, net operating income, 195,000, net operating income, 145,000. But the other thing is you don't have to worry about any of that stuff. We do put a management fee in there because if you're a responsible net lease owner, you want to see that the tenant have paid their real estate taxes. So you check that. The tenant should list you as the owner as an additional insured. So every year you're going to want to get an insurance certificate. And so you're going to want to follow up with that. You're going to want to follow up and make sure that they're doing the repairs. So if there is, and for example, this one here, you would want to make sure that the tenant has a roof maintenance contract. So you're going to want to say, send me proof of that if it's in the lease. And the same thing, you want them to maintain the heating, ventilation, and air conditioning. So you can see the rooftop units up there. So they should provide you with a contract. So it's going to be a 1-year contract, but it provides for quarterly maintenance where somebody goes in and changes the filters, checks the system and all the rest of it. Because you want them to make sure that they're maintaining the equipment and everything else. And then you don't have to worry about snow removal. You don't have to worry about landscaping. You don't have to worry about, cleaning the parking lot or, going out there and like I said, making sure. And as I said before, you're not dealing with tenants, taxes, termites, or toilets. It's just boom, you get that's why we like to and Adam and I have a podcast. We've entitled it Nothing But Net, because this is mailbox money. It's nothing but net operating income. So Adam, let's go on to number 4. Okay. Buying real estate is not only the best way, but the quickest and safest way to become wealthy. For those of you in the Chicago area, Marshall Field was one of the great uh, department store owners, and he created one of the first and probably the best department store. So he was known for the saying, "Give the lady what she wants." But what a lot of people don't know is that Marshall Field also was a huge real estate developer. So he put his stores in strategic locations so that it would develop, and he'd buy the real estate around them to take advantage of the development that would happen as soon as he put a store there. So genius guy, original entrepreneur, fantastic, life story. If you get a chance, look him up. He's an incredible entrepreneur. So we're into secret. I think it's number 4, right, Adam, or is it number 5? Yeah. So keep going. Go back, Adam. So corporate tenants.
Sorry
So
about that. I'm clicking a button and it's
that's all right.
you're good. Go ahead.
All right. So this is the big thing, and this is what we really like. So remember, we were talking about like the drug dealer in the apartment building, or you've got the tenants in the mobile home park, or you've even got, other types of tenants in other things. Well, with these type of tenants, you're typically working with a corporate tenant. So the greatest thing about these tenants is that they are really concerned about paying their bills on time. As we'll talk about later, they have financial strength, and they're concerned about bond ratings. But who wouldn't want Firestone Bridgestone, which is a Japanese company? They've got a market capitalization of 21 billion behind them, and they've got a great business model, which is changing tires, selling tires, because everybody needs tires. Everybody needs um, an oil change. Everybody needs the stuff that they're providing. But Firestone Bridgestone is also a manufacturer and has real assets. So I would much rather have that tenant that is on the lease to me versus, like I say, some of the people that I have leased to. I've leased to wonderful people. I mean, I've had some wonderful tenants, and they've been excellent. But I've also had some real losers, and I've spent more than my fair share in the courts in different areas of the country evicting tenants. So when you can get a nice, beautiful lease with a corporate tenant that has some significant strength behind them, let's go run down these are some of the people that we have not only done leases with, but we've invested with, and Liberty Fund is investing in these type of tenants. And one thing that a lot of people don't even see, but let's look at the bottom, Banfield Pet Hospital. So that's a chain. But Mars Pet Care, if anybody knows, Mars is M&M's. Mars is the candy company. Mars also owns, I think, Purina Dog Chow and all the rest of it. And those people have some significant. They're one of the largest private companies in the world. They're also billionaires if you look on the Forbes 400 list, but you wouldn't expect that they own chains of hospitals. So they own 4 different chains and they're 4 different banners. And so an excellent net lease tenant could be a pet hospital, because as we know, especially through the pandemic, more people are spending more money on their pets, and the pet veterinary services and all the rest of that has been a growing industry. So why don't we move on to the next one, Adam? So this is what I was talking about. So when we were talking about corporate bonds, you get the same thing as a corporate bond on the lease. In fact, even in a bankruptcy situation, and we've had a few tenants that go bankrupt, but rental payments are prioritized above all other debts, even bond debt. So aside from taxes that are owed to the government, the next priority, they have to pay you the rent. Okay. So we like to describe net lease properties as bonds wrapped in real estate. So you get all the benefits and actually extra benefits of a corporate bond, plus you get the tangible real estate. All right. Um, Long-term leases. So what we really like about these things, and we'll get into it a little bit, later in one of the other slides, but these tenants are there for the long haul. And the reason why they're there for the long haul is because it costs a lot of money to establish. So let's talk about a store opening. If Walgreens opens a store, it typically takes them about 3 years to reach their targeted number of sales. And I just also want to say that there are other areas of net lease. So there's industrial net lease, there's office net lease, there's even casino net leases where the casinos, I think it's Caesars and MGM did a net lease so that they sold all the physical buildings of the casinos out in Vegas to a REIT and a few institutional investors, and then they have a management company operating the casinos on the inside. But we've also seen net leases. As a matter of fact, Adam and I hosted a Chicago blockchain meetup, and there was a resort in the Dominican Republic, and they had a net lease with a movie studio out of Turkey that also did the Survivor TV series and some of the other ones. And so you can have net leases with hotels. But the main thing that I am talking about today, because this is what I know the best, and I wouldn't want to talk to you about something that I didn't know as well. I know a little bit about everything, but really what we're talking about is retail properties. And so I can tell you that the long-term lease agreement, they average is around 5 to 10 years. And so it's typically a minimum of 5 years. So with um, the self-storage facilities, those are really short-term leases. Hotels, it's like a one-day rental. And we know that residential is a one-year rental, and other ones aren't as long. But with these leases, it's a minimum of 5 years, because not only does a tenant have to reach their, targeted sales number, but there's also a large investment that goes into setting up the store, building it out, and all the rest of it. And so most of these leases are 10-year leases and will extend out sometimes 15, 20. We've even done a 50-year lease. And I like to talk about this story. I have a Walgreens at a shopping center that we started in 1990. And this Walgreens was put in there in 1957. We ended up in 2010 moving the Walgreens out to an out parcel. So we did a freestanding net lease property deal with them. But the original Walgreens lease was so old that it didn't even have a zip code. And so when we moved them out to the out parcel, we did a 50-year lease with them. It's one of the top stores in the chain, but also it just goes to show you that they had been there since 1957. In 2010, they do a 50-year lease. They expect to be there for another 50 years. And you just don't hear about that. And looking back over the past, well, now we're on 31 years. It's been, you cannot beat that as a tenant, because the tenant pays automatically. The tenant sends you the checks, typically in an ACH, so it gets deposited directly into your checking account. Most of the time, you don't even get a physical check. So that's the great thing. And then the tenant takes care of everything. The tenant pays their own real estate taxes. The tenant and you've got this really long-term lease that you know the tenant's going to be there, you know that it's a stream of income, and you don't have to worry about variable income because you can budget that the rent is going to be there and the real estate taxes aren't going to increase and cut into your income. Or what happens in the Chicago area is you get a number of bad snows, you end up paying a lot more in snow removal and ice removal than you expected. So Burton Maciel is a Princeton University economics professor, but he also wrote the best-selling book, A Random Walk Down Wall Street. He says that it's been a reliable inflation hedge, and that's what we've talked about. And we also say that it's been probably the most dependable in terms of cash flow and paying regular monthly income. So this is our next net lease secret. Take a look at this. Even when apartments are going great, industrial's probably slightly higher right now than it was in 2019, 2020. But take a look at the single tenant net lease, and that is what you want to see. It's consistent occupancy over and over and over again. This is just like it's never going to be a complete home run unless you buy in a fantastic area and you're doing more or less of a covered land play, or it just happens that you bought a Jiffy Lube in Austin like 20 years ago and you're there on the corner of Main and Main. So you do get those, and you want to like be aware of where you're investing in. And so you want to be aware that some of these net leases that you see for higher cap rates are in the middle of nowhere. And so if the tenant leaves, it's going to be much harder to do something with that. But take a look at that occupancy rate. This is why we like it. It's consistent cash flow year in, year out. And you know it. And everybody's going to ask me, well, what about COVID? Well, I can tell you that most of the net lease properties, especially anything with a drive-through, were open and operating during the all through the pandemic. What I will caution you about is if it was a Marshall's, if it was a Ross, if it was somebody like a full-service restaurant, like a Longhorn, or a Chili's or something like that, that was sit down, they got punished because a lot of governors, especially in the north, closed down those type of things. But if also there's freestanding Walmarts, freestanding Targets, freestanding grocery stores, all of them have super huge credit, and all of them were open and actually busier than ever during the pandemic. So in our portfolio with Liberty Fund, our portfolio was designed to be internet resistant. And not only was that making it internet resistant, but it also made it COVID resistant. So most of the tenants in our portfolio were open all the way through. I can tell you that we had some shopping centers where we had tenants close down, and we had to work out rent reductions and other things like that. And you're seeing it now in apartments where these governors have put these eviction moratoriums and everything else on. Especially, I wouldn't want to own anything in California right now because it's basically said, well, you don't have to pay any rent, and you won't be evicted. So anyways, let's move on, Adam. This is, Mark Twain has so many great quotes, but buy land, they're not making any more of it, which is true, except for, as I always like to point out, if you live in a volcanic island like Hawaii, then there's new land being manufactured all the time. And I also want to point out, having visited Dubai in October, that they created extra land and put together some palm trees and islands out in the middle of the Gulf. So for the most part, they're not making any more land, but and we can count on that. And I wouldn't want to live that close to a volcano where the new land is being made. But I would love to live in Hawaii. So let's keep moving on, Adam. All right. So as I discussed before, my primary experience is with retail real estate. And so what I really like about retail real estate is not only is it mostly the best locations in a market, but it's also something that you can reuse. So let's take, for example, this CVS right here. You've got 30,000 cars a day, close to 40,000 cars a day going right by the front of it. You've got stoplighted intersection or signalized intersection. You've got right in, right out. You can't beat this. And it's right in the middle of where all the action is. So even if this wasn't operating all the way through as a CVS, it's going to be highly desirable for other types of uses. And it's also at some point, if that doesn't work, this would be a great area to put like a mixed use residential or something else. The land is too expensive to do that, but you can see all the residential density right across the street there. So even if it doesn't work out as a retail site, but you want to make sure that you're in the heart and the nexus of all the retail. It is fantastic locations. So as we like to say, they're easily repurposed. They're highly visible. You've got strong tenants. This is a main and main location. And as you can see, it's real assets that produce real cash flow. And the best time to plant a tree was 20 years ago. Second best time is now. So investing right now is the way to go. And I can tell you this, I just attended the Real Estate Guys Create Your Future Goals seminar. And we have some really big investment goals this year. We have some really big money raising goals this year. And we have some goals that are we want to create cash flow, generate wealth, and put together flourishing human beings in our investments. So we've got some super huge goals to achieve that. Okay, we will send you a copy of this slide. If you will just send us a something in the chat box that you want it. Keep going. Let's go back there though. Let's just review it a little bit, Adam. So as we talked about it, and then I just want to point out again, this is retail real estate. If you would buy an industrial property, it's not going to be as well located because industrial land is the industrial tenants don't pay as much rent, so they're going to be in a different type of location, more than likely going to be off the beaten path and everything else. Same thing with an industrial distribution facility. They're not necessarily going to be here. I can say that there have been more and more industrial distribution facilities making their way into retail areas because they want to be last mile as close as possible to delivering to the people. But with that said, I don't know as much about those properties. I know enough to be dangerous, but I will focus on retail because that's what we like. So standalone, highly visible properties, long-term leases, the properties themselves generate significant demand. They also are like a billboard so that, if a tenant, puts signage all over it, it increases their brand awareness. And you've got the advantageous lease structure where the tenant pays for everything. They're long-term leases. What we talked about, and there's actually special tenants like gas station tenants or convenience store type of tenants that qualify as special federal fueling centers. And so they get accelerated depreciation and extra depreciation. So there's all kinds of really cool tenants out there that not only pay rent and regular rent increases, so yearly rent increases, but also get you extra depreciation and get you extra tax benefits. And then as we talked about, huge advantages over bonds in the stock market, nowhere near the volatility of the stock market. And bonds, if you invested in bonds right now, all your money is going to be eaten away by inflation. So especially when I see negative bond yields in Germany, and I can't remember. I think the Treasury ticked up a little bit, but 1% for a U.S. Treasury. I don't know. I think that I'd rather right now put my trust in Shell or Exxon or 7-Eleven or CVS or Amazon or Walmart than I would buying a US bond right now. So, and this is what a lot of people ask. They're like, well, why would a tenant get into this type of lease structure? So the big thing is, especially with retail tenants, is they have aggressive expansion plans. So when they're expanding across the country and they're opening up, let's say 20 to 100 to sometimes 300 stores a year, it makes it much easier for them just to lease. They also get punished on their stock price and their balance sheet if they're carrying real estate on their balance sheet. So with the rent, it's 100% deductible. If you own the building, as anybody that's owned real estate knows, you cannot deduct the principal. So this way it's 100% reduction, and it's easier to scale their business model, and they don't have to tie up money actually in the building itself. That boom, they're off to the races. So as we talked about, real estate is the original asset class. Secret 2, advantageous lease structure. Secret 3, which everybody loves, it's mailbox money. Secret 4, you don't have to deal with like crazy tenants. And I can tell you, forever and ever, crazy tenant stories on residential. I can also tell you some crazy tenant stories on commercial. But most of those crazy tenant stories happened in shopping centers with the local type of tenants. Um, Very rarely did any shenanigans happen with the corporate tenants. Secret 5, we got the long-term leases. Secret 6, as you can see, historical high occupancy, and we don't expect that to go away. We expect these type of tenants and this type of real estate to be in more and more high demand. And then you've got location advantage. So check us out, libertyfund.io. We have a bunch of other information there, a bunch of articles for you that describe net lease investing. And also Adam and I, as we said before, are the co-host of the Nothing But Net podcast. You can find that at nothingbutnet.us, or a much simpler that will get you there is Triple Net RE. That's TRIPLENET.RE. So Triple Net Real Estate, remember that. And that's the podcast that we do. It goes in depth. And then we're currently putting together a book on net lease investments. So check us out. I really appreciate you showing up today. Sorry, that's my Corona going.
We're coming back. Thank you, Michael. Thank you for and for the few bumps in the road there. You did a great job. It was tough to go back and forth from the buttons and the microphone. So a few things I want to highlight.
It's our first one using this software, and it's a little bit rough. The next one should be much smoother.
Definitely. So anyways, a few things that you said there that I wish we had some more time to dig into. We've got about 10 minutes for Q&A. So any questions that you guys have, please, go ahead and put those in the chat box. We have the Q&A box as well. I guess let's direct it to the Q&A box if you can. It'll just be a little bit more organized. But the crazy tenant stories, Michael, I wish we had some more time for those. The multifamily jokes were good too, because I think, well, it shouldn't even really be that much of a joke. I think most people or most investors just aren't aware of the opportunity that's here in the net lease space. And, I've been in this game for not too long, but I do remember when I first got started, a lot of investors would turn their nose away at like mobile home parks, for example, and then fast forward 3 years later, and now it's the new hot topic. So I don't think there's really
and at the time, institutional investors weren't investing in it, except for Sam Zell's, real estate investment trust. And now, institutional investors are investing in mobile home parks. But net leases didn't become a thing up until about probably the mid 90s, early 90s. And then they became kind of their own asset class. And one of the guys on our advisory board, Alex DiMaturco, ran the largest net lease real estate investment trust in the world, in fact, and it was a multi-billion-dollar real estate investment trust. And he grew that thing, just astronomically through the early 2000s. But a lot of people aren't even aware that when you bring up net lease, it's like, what is it? So we're just trying to educate people on that. It's not necessarily an alternative asset class. It's an excellent asset class that more people should look into, especially if you're a passive investor. You should look into getting exposure to this. You might not get, and I get a lot of deal flow with apartment syndicators, and they all have this super high IRR, and I don't, it's all based on, oh, we're gonna do X amount of dollars in cleaning up this place, and then we're gonna raise the rents. Well, I'd like to see how much rent raising went on this year. They make the assumptions, and a lot of these guys, and they're all quality guys. I know a lot of them. But a lot of them have gotten into the real estate game since 2011, 2013. And so the real estate world has been nothing but up. This is my fourth downturn. And I can tell you that stuff goes up and down. But what I also can tell you is the most consistent and the thing that we have had a ton of tenants on these national credit tenants, they don't miss a rent payment. So if it's not about somebody losing their job. It's not about, the dog ate my rent check and something like that. They're there consistently all the time. So, and hello, Allison. It's great to see you. Thanks for coming. And it was good to see you in Dallas this weekend. I hope you got your goals finished.
All right, and we had some good questions come through here. You mentioned Allison. First one was from Aaron Eiler. Is how would you suggest for someone that was just introduced to this strategy and structure to get involved and learn more?
I would suggest you do a little bit of research on it. Like I said, a nice starting point is our podcast because it kind of tells, but you actually need to not only know a little bit about real estate, but you also have to research the tenant. And I would suggest that you specialize in a type of tenant. So what I've seen in the past is some people say, oh, I'm going to invest in dollar stores over here, and then I'm going to invest in fast food over here. And what I say is that you're investing in an operating business when you're investing in these type of tenants. And especially if you want to go with industrial, you need to know that the tenant has a business plan and some sort of a value add proposition that they're going to be in business for the next 20 years. So you want to not only investigate the what the best location is. So, for example, who do we have on the podcast? Jeff Cermak.
Jeff
And
Cermak, yeah.
Yeah, and Jeff did real estate for not only McDonald's, but he also did real estate for Starbucks. He did real estate for these title companies.
7-Eleven.
Super sharp guy, did real estate for True Value. And so he was just knocking off. It's like, okay, if it's Starbucks, they want to be on the morning side because they want people to turn in. They have to have X amount. If it's McDonald's, they now have to have room for a double drive-through, and they have to have X amount of square footage for the land, and all the rest of it. And so that's the type of thing that you just need to know. You just need to do a little bit of homework. It's exactly like investing in a single family home. You need to go and look at what the market is. You need to go and look at what's attractive for people. And but you need to do the added investigation as into, does the tenant have a good brand? Does the tenant have a good business proposition? And you need to look at the tenant credit, and you can look up the tenant credit ratings, Moody's, S&Ps, Fitches. They all do tenant credit ratings.
All right, and we're going to go rapid fire mode here, Mike,
All
because
right.
we got about 4 questions in about 5 minutes. So first one was from Kermit. Is it beneficial to have, first time seeing this word, sorry, allodial title with
I haven't done anything to know what a alloidial title is for a long time, Kermit. So I don't know what that is. So honestly, that goes back to my original real estate license, and I can't remember what a alloidial title is. So I can't tell you whether it's beneficial or not. So
All
I
right.
can't tell you that net lease properties do appreciate in value. Number one, they appreciate in value as the location gets better, and number two, they appreciate in value depending on the tenant. Sometimes they don't really appreciate in value. Sometimes they just kind of stay the same. But for the most part, there is a built-in appreciation with the properties. And so, for example, in the past, I want to say since 19, somewhere around 1990 through now, they have appreciated. Again, you don't get the forced appreciation unless we've done this strategy before. We've bought properties that have tenants that have a 3-year lease on them, and we've bought them in a good location. So if we can't renew the tenant in the type of rent that so the new rent, they typically go up in value because as the tenants renew, you renew them at a higher rental rate. So I can tell you probably about 5 or 6 or 7 deals. We had shorter term leases. We took the risk on the lease because we knew we could put a replacement tenant in. And so you either say to the tenant, this is what we'd like to, renegotiate with, and we'll take a lower rental rate sometimes on an existing tenant because there's less costs. But in certain situations, we just said, hey, thanks, but no thanks. We're going to release it. So I can tell you, one of the deals directly across the street from, and you could see it in that location advantage, there was a Jewel Osco, which is owned by Albertsons, and the landlord, Albertsons wanted to renew badly because it was a good location for him. The landlord said, no, thank you, we're done. And then the landlord turned around and is doing an Amazon Fresh store. So that's where you get some super huge appreciation because the Albertsons is going to get you probably like a 5 cap or something like that. And you'll get a nice store there, but it'll never knock anybody's socks off. But as soon as they put the Amazon in there, which more than likely is paying more rent, but you're going to get a 4 cap on an Amazon Fresh store.
All right. And Allison Brown has a question. I got one from Fletcher Wheaton as well. And you kind of touched on SIBA. SIBA, we can probably circle back to that one last here. So Allison says, if it's not a true triple net property, but mostly triple net, is that automatically a bad thing? Or as long as you understand what the owner is on the hook for, what the tenant paid and what the tenant pays for, can they still be a great investment?
Yeah. So, Allison, I would say that I'll use the example, and there were 2 deals that we were looking at in Tennessee. One was a Dollar General, which was a pure triple net lease. But Dollar General, and I want to warn people about this, you can get some high caps on Dollar General, but if it's a brand new lease, Dollar General does 15-year leases and their leases do not increase. So then you get no appreciation on your lease. So you want to buy a tenant that has regular increases, preferably. A lot of tenants have yearly increases, but at least an increase every 5 years. So we don't buy a lot of Dollar Generals for that reason. But there was side by side in 2 different towns in Tennessee, and then there was a Family Dollar store. The Family Dollar store not only increased, but the Dollar General's pure triple net, flat for 15 years. The Family Dollar is a double net, so that the landlord was responsible for the roof and the structure. It was a brand new build. Both of them were brand new builds. I'll take the risk on the Family Dollar. I need a slightly higher cap rate because I know that I'm going to have some roof repairs and I'm on the hook for structure. So you're going to want to get a good engineer's report and make sure everything is in good condition. But I've got rent increases from the Family Dollar. I'm going to get a higher cap rate. So you want to just make sure that you're paying, you get a risk reward. So if I have to pay for, roof and I have to have risk on that, I want a higher cap rate on that deal. But I can say that I would take a hard look at the Family Dollar, and we did, versus the Dollar General. The Family Dollar ended up being a better deal.
Thank you, Michael. Fletcher wants to know, what are your thoughts on medical tenants for net lease properties? It seems like a great space, but people are looking to avoid large hospitals and longer wait times these days.
My thought is I want to hang out with Fletcher and Cabo. That's the only thing I'm thinking about right now. It's winter here in Chicago, and I just want to hang out in the land of the free down in Cabo with Fletcher. So, but to answer your question, Fletcher, you do have a point, and there's a type of tenant called what we like to call a dock in the box. They're an emergency care center, and they've been taking prominent locations out in the front of shopping centers, out in like highly traveled, areas. And they have just done fantastic. Number one, because people don't want to go into a hospital, there's long wait times. And because, some of the hospitals in different areas like our area, were just death zones because of the stupidity with COVID. But the other thing is that they also made a killing on doing COVID tests, and they're still doing COVID testing, the rapid testing. So that's a great tenant. We really like the dialysis tenants. So there's DaVita and Fresenius. They're both credit tenant leases. And they're both international companies with huge assets behind them. And those always people, that are on dialysis, the risk with that is that they find a cure for kidney dialysis, and then those go away. But for right now, those things are needed 24 hours a day. And so what we like to invest in are called medtail tenants. So it's medical retail. And we actually own the website medtail.com. But the other thing is we really like Aspen Dentals or Heartland Dentals or the dental supply, the dental places. And we also classify the pet care, the veterinarians and stuff like that in our medtail. So, and like I said before, you could buy a Banfield pet hospital. They've got I've seen some super great cap rates in Georgia. One of them was like a 7 cap, and you get Mars credit. I mean, I'll take that all day long.
Love it. All right. So last question here, Michael, and you kind of already touched on this, but I guess just to recap it one more time, how do the triple net properties appreciate in value, and what are the models for exit strategies?
I did try to answer that, but they appreciate in value mainly because the rent increases. So, like I said, they're not going to appreciate in value if you buy a Dollar General. It's going to just kind of stay flat unless the cap rates decline. So that's when. So if interest rates go down and your cap rates compress, you're going to get appreciation. You want to buy net lease properties that have rent increases, and that's an automatic increase in value. Number two, you want to buy in excellent areas with good locations so that when the tenant comes up for renewal or the tenant exercises the option, the tenant's going to want to stay there. So that's how you get it. And then, as I said before, you can also force appreciation but this is a much more sophisticated strategy. You have to have relationships with tenants, and you have to know a little bit more about what you're doing. But I think anybody can, figure out how to do it. It's just like the amount of time that you would spend trying to figure out how to do a value add apartment building. If you spend that amount of time trying to do net lease properties, I think, it's an excellent thing. And then, you can be on the beach with Fletcher and Cabo, just collecting rent checks and not worrying about whether, the tenants are, trashing your building and is setting fire to it and anything else.
All right. Well, that's all the time we have for today. Ladies and gentlemen, thank you so much for investing your time with us here on this Liberty Real Estate Fund webinar. What are the top 7 net lease secrets? You learned them here today. If you found value in today's message and you're with us on the replay, be sure to like, share, and subscribe there. Michael, what is the best way for anyone tuned in to follow up and get in touch with you or us at Liberty?
You can contact us at hello@libertyfund.io. That's hello@libertyfund.io. Or you could go to libertyfund.io and fill out the contact page. I am also on LinkedIn. Adam's on LinkedIn. We're all over the place. Try to be, big, bad, and nationwide. So just reach out. And I am more than happy to talk to people that are interested in net lease properties, because I think it's something that there's a lot of education out there on multifamily, on single family rentals and all the rest of it. There's not a lot of education on this. So we want people to know that this is an excellent place to invest their money.
Absolutely. And one more big thank you to our team, Courtney, Sharav, Jordan, Sam, Jason. You guys are fantastic to work with. One more time to our audience. Again, a pleasure interacting with you guys today. Thank you for your questions. Thank you for tuning in. This was What Are the Top 7 Net Lease Secrets presented by Liberty Real Estate Fund. My name is Adam Carswell. Michael, any final words?
That's it. Thank you very much for coming. Really appreciate your time today.
Thank you for tuning in. And guys, remember, in all you think, say, and do, take it to the next level.